I think the sell-off Friday is giving us a bit of a gift because that surge in the VIX, a 32% rise, is the 39th highest ever one-day surge. And the 1 month median return is almost 3% of the 38 other instances. So I think the S&P could add, 200 points between today and mid-November. I think that the volatility and leverage is what has drawn people into that space, especially when you get outside of Bitcoin and Ethereum. Those two are generally not held on margin. I mean, there is some leverage with what they call perpetuals, but that's why they held up so well over the weekend. But this liquidation that was triggered over the last 3 days, the estimates are at least 19 billion of liquidations, but it's probably understated. It might be 4 times bigger. It's the largest since 2021. Essentially, you have to go back to FTX.
Financial markets are walking a tightrope, and last Friday's sharp sell-off was a harsh reminder of how quickly sentiment can shift. The S&P 500 plunged 2.7% in a single session, but beneath the surface, a far more dangerous dynamic was unfolding. The VIX, Wall Street's fear gauge, surged 32%, marking one of its biggest one-day spikes in history. For traditional investors, it was a bad day. For the crypto market, it was a full-blown reckoning that exposed a hidden web of extreme leverage few truly grasp. This wasn't just a typical market correction. While stocks took a weekend breather, crypto never sleeps, and that's where the real chaos hit. A massive wave of forced liquidations tore through the market, wiping out leveraged positions on an unprecedented scale. Estimates suggest at least $19 billion in liquidations, though some believe the true figure could be several times higher. This was no ordinary pullback. It was a structural unwind that revealed just how fragile the system of perpetual contracts has become. Analyst Tom Lee remains optimistic about traditional markets, projecting the S&P 500 could reach 7,000 by year's end. But his warning about crypto's leverage crisis is stark. Perpetual contracts, allowing traders to borrow 20x, even 50x their capital, turn small moves into catastrophic losses. A mere 5% drop can erase an entire position, setting off a chain reaction of forced selling that feeds on itself. Long-term Bitcoin and Ethereum holders tend to avoid such risks, having learned from past collapses. Yet for active traders, these instruments remain a dangerous temptation, offering huge upside for the lucky few and total wipeouts for the rest. When that leverage unwinds, it doesn't just trigger a dip, it can ignite a systemic cascade that turns volatility into a full-blown crisis. President Trump just opened the door for 401k funds to invest in crypto, unlocking a nearly $9 trillion market. That means millions of Americans can now put retirement savings into digital assets, and you can start today. If you have an old 401k or employer plan sitting in boring stocks or bonds, roll it over into a crypto IRA with ITrust Capital and position yourself for the crypto boom that's building now. With ITrust Capital, you can buy, sell, and hold crypto 24/7 with top-tier security and enjoy the tax advantages of an IRA, no capital gains taxes like regular exchanges. Plus, they offer the lowest fees in the industry. Open an account today with promo code DOSE7 for a $100 funding bonus. Over 10,000 5-star reviews. They'll help you roll over your funds quickly and easily. Don't wait, beat the crowd.
In fact, I think JP Morgan's announcement today really ties into why investors should stay pretty constructive on the U.S. I mean, JP Morgan, the biggest and the most powerful bank in the world, is investing $1.5 trillion into the U.S., into things that are going to strengthen sort of U.S. advantages, critically important areas. And at a time when the U.S. is dominating AI, and of course now we have this big tailwind as blockchain is an initiative that Wall Street is building products on. So I think there's a lot of reasons for investors to stay optimistic. And I know there's a lot of talk about bubbles, but I think the thing I would just continue to point out is NVIDIA trades at around 27 times forward earnings. It's still on a PE basis cheaper than Walmart and Costco, which trade at around 47 and 34 times forward earnings. And as you know, CEOs have not been that confident for the last 2.5 years because the Fed's been running tight monetary policy. The ISM's been below 50 for 31 months now. That's the longest stretch in history. I think the sell-off Friday is giving us a bit of a gift because that surge in the VIX, a 32% rise, is the 39th highest ever one-day surge. And the 1 month median return is almost 3% of the 38 other instances. So I think the S&P could add 200 points between today and mid-November. I think conviction is a measure of whether or not the market is, pricing in too much good news. I think with Friday's sell-off, I saw many people calling the top of the markets or declaring that the bubble is bursting, or that, this is the reason to be buying gold. And if investors are that quick to call a top just on a 2.7% decline, I just think a lot of good news isn't really priced in. I think there's still a lot of reluctant investors on the sidelines. There is an interesting correlation we found, which is when I look at Tether's supply of dollars outstanding, it really started to rise about 3 months ago, and that corresponded with gold essentially going up every day. I'm not positive of this, but I think stablecoins, including Tether, may be one of the largest buyers of gold today. Tether is proving to be a good meeting ground between Bitcoiners and gold people. There has always been a lot of leverage in crypto. I think that the volatility and leverage is what has drawn people into that space, especially when you get outside of Bitcoin and Ethereum. Those two are generally not held on margin. I mean, there is some leverage with what they call perpetuals, but that's why they held up so well over the weekend. But this liquidation that was triggered over the last 3 days, the estimates are at least 19 billion of liquidations, but it's probably understated. It might be 4 times bigger. It's the largest since 2021. Essentially, you have to go back to FTX. I think there is a lot of leverage in the way people use this product called perpetuals, which is trading on margin, like 3x, 20x. And it lurks and it's held through collateral. People like sort of pledging something that thinks it's safe, but when the price of that collateral drops, it triggers a cascade. Right. And so I think people talk about this thing called auto deleveraging. So a lot of leverage. Yes. There is this very popular trade in crypto called buying a perpetual, which is not necessarily buying the crypto itself, but buying a synthetic version of it with leverage. It was originally created by BitMEX many years ago, but even exchanges like Coinbase offer this as what they call like a 20x or even 50x leverage. So with 5 cents of collateral, you can buy $101 worth of a crypto. Now that's fine if someone's a really good trader, but of course, as you know, if something moves 5%, right, that collateral is lost. I think most buyers of Bitcoin and Ethereum are cash buyers because Bitcoin is $2 trillion, and you wouldn't be you'd see that much leverage if it was out there. But for the active markets, I'm going to guess it's 5% of all trading is with perpetuals, but as you know, that's a lot of volatility, and it's triggers what we call collateral cascades, and that's what happened over the weekend.
Does that worry you, Tom?
Oh, yes. As you know, Warren Buffett has said, derivatives are the weapons of economic mass destruction. There's a lot of leverage both in the traditional financial world with structured notes and equity derivatives and private credit, and there's a corresponding system that exists in crypto. But I think that's why most people who own crypto should view these events as a lesson in leverage, number one. But two, as we know, volatility like this really gives an advantage to an investor because someone got a chance to buy Bitcoin at 107,000 and Ethereum at 3,600, and Ethereum's back to 4,200 now. As a first principle, Bitmine, which is the largest holder of Ethereum in the world, doesn't use any leverage. It's a fortress balance sheet, taking a page from Jamie Dimon's playbook. Large holders have a responsibility to have a super clean balance sheet, and that's a first principle of Bitmine. I think most people I know in crypto do not use leverage because they've lived through those systematic drawdowns. So I think most people who have a lot of experience avoid leverage.
Tom Lee offered a detailed breakdown of how the recent turmoil unfolded. It all started with a political post from President Trump on Truth Social, voicing concerns about China and hinting at a steep rise in tariff. That single message sent shockwaves through the markets, triggering a 30% spike in the VIX, the 39th largest one-day surge ever recorded. The ripple effects soon spilled into the crypto markets over the weekend, sparking what Lee called one of the biggest liquidation waves since the FTX collapse in 2021. While Bitcoin and Ethereum remained relatively resilient, the altcoin market was crushed, with tokens like Solana and Cardano plunging more than 50%, signaling a widespread leverage flush. Despite the chaos, Lee views the volatility as a potential setup for opportunity. Historically, when the VIX jumps by this magnitude, the S&P 500 tends to rebound with a median gain of nearly 3% within a month, equivalent to roughly a 200-point rally that could push the index back toward record highs. His base case for the S&P 500 remains 7,000 by year's end, supported by favorable seasonal trends and a more accommodating Federal Reserve. Lee also dismissed claims that markets are in a bubble, pointing to Nvidia, the poster child of the AI boom, trading at a forward P/E of 27, cheaper than even Walmart or Costco. For perspective, he compared it to Cisco in 1998, which traded at 56 times earnings before soaring to an unsustainable 210 times. To Lee, today's markets aren't showing signs of euphoria, they're showing signs of resilience.
Because there's been some turmoil in markets lately. It all started with Friday, October 10th, when President Trump posted this very long post on Truth Social. And there he was talking about his concerns about actions taken by China and what he called export controls. And he was going to respond with a massive increase of tariffs. Now, that happened at 11 a.m. on Friday. And after that, the VIX spiked more than 30%. In fact, that was the 39th highest ever surge in the VIX, so it's unusual, and the highest one-day jump since December 18th, 2024. Now, the markets fell 2.7%, so it was a bad day, but the volatility is what I've been focused on. And then at 4:50 p.m. Friday, President Trump took actions and imposed a 100% tariff on China. Now, that caused a huge downturn in futures quickly during that short window. And crypto markets, which trade over the weekend, underwent a massive, massive sell-off. In fact, it triggered what is expected to be one of the largest ever one-day liquidations, the largest really since 2018 and 2021. And in 2021, that had to do with FTX. To give you an idea, someone posted this on Twitter that outside of Bitcoin and Ethereum, which held up well, look at things like SUI or Cardano, which went from 80 cents to 30 cents. SUI went from $3.40 to 56 cents. So clearly a huge liquidation. But then by Sunday evening, President Trump said, don't worry about China. All will be fine. So in some ways, I guess that liquidation and turmoil over the weekend looks like it's largely going to reverse as we move through October. So that gets us to this point, which is that when VIX spikes happen, they usually happen at the lows. Now take a look here at the upper half of this chart is the S&P over the past year, and the bottom half is the VIX one-day percent changes. And as we highlight here, when you see these spikes in the VIX, one-day spikes, they usually happen at the low. So I think that's the case again. And in fact, the numbers prove this out, that if you look at the instances, the 38 instances when the VIX has surged more than 30% in one day, and then the median forward returns, you can see that 1 month later, the median gains roughly 3%. That implies a 200-point gain for the S&P by mid-November. Okay, back to all-time high. So we would be buying the dip. And in general, we think October and the rest of the year has seasonal tailwinds. Basically, between October and year-end, we should expect the S&P to gain around 4%. That implies 7,000. But as we've talked about before, because the Fed's been on pause all year and then they're cutting in September, that's just like 1998 and 2024. And the S&P did even better into year-end, up 14%. So I think 7,000 is just the base case. And as for Granny stock, individual stock performance, the top 5 performers over the past week were AMD, Lam Research, Strategy.com, KLA-Tencor, and Robinhood Markets. A lot of this is just AI again. And what helped AMD was the OpenAI strategic partnership where OpenAI was going to take up to a 10% stake. That caused AMT to surge 20% and reach an all-time high. We're happy about that. Now, for those who think we're in an AI bubble, just keep in mind a chart I've produced in the past. The most important company to watch is NVIDIA, and it's trading at 27 times forward earnings. Okay, it's got a lower multiple than Costco, which is at 48 times, and at Walmart, which is 34 times. Okay, and equally important that if you go back to 1998, September 98, which is when the Fed was on and then cut in September, Cisco was the same stock then that NVIDIA is today, and it was trading at 56 times forward earnings. Look at its PE. In a year and a half, it went to 210 times earnings, a 4x increase in its PE multiple. Okay, that's what I would say is valuations where you can be concerned about valuations. Now, the bottom 5 stocks over the past week were American Express, Bank of New York, Netflix, Meta, and Live Nation. And as far as themes go, the best performing theme was global labor suppliers, led by AMD, followed by Style Tilt.
Tom Lee remains optimistic on markets but warns that crypto carries a hidden danger: excessive leverage, especially via perpetual contract. Echoing Warren Buffett's warning on derivatives, he notes that the recent $19 billion in liquidations exposed how quickly leveraged positions can blow up. While bullish on stocks, Lee emphasizes discipline in crypto. Major holders like Bitmain avoid leverage, knowing its risk. Despite the crash, the long-term case for digital assets is strong. AI adoption, institutional interest, and new financial tools point to growth, but crypto's volatility punishes overconfidence. The same swings that draw traders and can destroy them if they chase fast profits. Lee's message is clear. This crash is a lesson, not just a loss. Hidden leverage is crypto's silent threat, lying in wait for the next storm. Enter the space prepared, stay aware, stay disciplined, and remember, the real danger isn't the crash itself, but believing it can't happen. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.